I now hand the conference over to Mr. Neeraj Basur. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. This is Neeraj Basur. First of all, I hope all of you and your families are safe and all of you are taking the necessary precautions. And to begin, I wish the best of health to you and to your families. Today, I will be providing you an overview of the results of Blue Star Limited for the quarter and year ended March 2021. First, I will cover the financial highlights. With an improvement in the general business sentiment and the early onset of summer in some parts of the country, all business segments witnessed growth as compared to Q4 levels last year. The overall business recovery for the year was satisfactory and better than expectations at the year beginning. Several cost rationalization and capital preservation measures, coupled with prudent working capital management, resulted in healthy generation of cash from operations. These measures enabled the company to close FY21 with a strong balance sheet and a healthy liquidity position. Financial highlights for the quarter ended March 30, 2021 on a consolidated basis are summarized below. Revenue from operations for Q4 FY21 recovered 124% to rupees 1611.56 crore as compared to rupees 1299.36 crore in Q4 FY20. EBITDA, excluding other income and finance income, for Q4 FY21 was rupees 101.81 crore, EBITDA margin 6.3% of revenue, as compared to rupees 37.33 crore, an EBITDA margin of 2.9% of revenue in Q4 FY20. Other income in Q4 FY21 includes a profit of rupees 32 crore from the sale of an office property in Mumbai, which got consummated in Q4. PBT before exceptional items was rupees 103.34 crore in Q4 FY21 as compared to rupees 13.08 crore in Q4 FY20. Healthy cash from operations and improvement in working capital efficiencies enabled a reduction of rupees 282.46 crore in net borrowings in Q4 FY21. Financial highlights for the year ended March 31, 2021 on a consolidated basis are as follows. Revenue from operations for FY21 recovered 79.5% to rupees 4263.59 crore as compared to rupees 5360.19 crore in FY20. EBITDA, excluding other income and finance income, for FY21 was rupees 239.81 crore, EBITDA margin 5.6% of revenue, as compared to rupees 282.78 crore, EBITDA margin 5.3% of revenue in FY20. Improvement in EBITDA margin was driven by improved profitability across businesses coupled with cost rationalization measures. PBT before exceptional items recovered 69.1% to rupees 145.15 crore in FY21 as compared to rupees 210.02 crore in FY20. Tax expense for FY21 was rupees 47.09 crore as compared to rupees 65.32 crore in FY20. Net profit for FY21 recovered 70.1% to rupees 100.35 crore as compared to rupees 143.25 crore in FY20. Carried forward order book as of March 31, 2021 remained almost flat at rupees 2952.42 crore as compared to rupees 2946.59 crore as on March 31, 2020. Capital employed reduced to rupees 756.41 crore as on March 31, 2021, as compared to rupees 948.62 crore as on December 31, 2020, and rupees 951.13 crore as on March 31, 2020, because of our continued focus on enhancing our working capital efficiency. We ended the year with a net positive cash balance of rupees 151.45 crore as on March 21, as compared to a net borrowing of rupees 131.01 crore as of December 20. Our net borrowings were rupees 155 crore as on March 31, 2020, with a debt equity ratio of 0.21. And needless to say, on March 21 this year, we have, on a net debt basis, a nil debt equity ratio. Business highlights for FY21. Segment 1, electromechanical projects and commercial air conditioning systems. Segment 1 revenue grew 18.1% to rupees 779.96 crore in Q4 FY21 as compared to rupees 660.39 crore in Q4 FY20. Segment result was rupees 48.50 crore, 6.2% of revenue in Q4 FY21, as against rupees 3.17 crore, which was 0.5% of revenue in Q4 FY20. Segment revenue for the year recovered 78.5% to rupees 2218.72 crore as against rupees 2826.67 crore in FY20. Segment result was rupees 106.49 crore or 4.8% of revenue in FY21 compared to rupees 120.26 crore or 4.3% of revenue in FY20. Order inflow during the year was rupees 2244.84 crore as compared to rupees 3104.67 crore in FY20. Electromechanical projects business. As expected, order inflows continued to be slow from the commercial building sector, which is yet to recover. Muted government expenditure also impacted order inflows in the infrastructure sector. Order inflows from the factories and light industrial sector improved as compared to last year, driven by the Make in India initiatives of the government. We continue to moderate the pace of our execution basis assessment of customer credit profile and operating cash flow visibility for the ongoing job, which enabled an improvement in margins for the business. We will continue to focus on the infrastructure sector, such as metro railways, electrical substations, and water distribution, which are expected to offer immediate growth opportunities. Factories, data centers, and warehousing sectors are also expected to throw up good opportunities in the upcoming quarters. Carried forward order book of the electromechanical projects business was rupees 2149 crore as on March 31, 2021, as compared to rupees 2039 crore as on March 31, 2020, a growth of 5.4%. Segment-wise breakup of the carry forward order book of the electromechanical projects business is as follows, and I'll just cover that. You'll get it in a tabular form when you see the release. So in our office, IT and non-IT segment, our share was 29%, metro rail 22%, hospitals 9%, industrial 9%, power generation and distribution 6%, malls 4%, others which includes segments such as airports, hotels, educational institutions was 21%. I will now talk about our commercial air conditioning systems. Our commercial air conditioning business registered a growth of 19% during the quarter. While order inflows from key sectors such as IT, offices, marriage halls, and auditoriums continued to be dominant, we channelized the focus on the emerging sectors such as healthcare, pharma, and light industrial. We continue to maintain our number one position in ducted air conditioning, number two in VRF, and number three in chiller product categories. We added new large capacity models and site discharge system for residential use to our VRF product range and have now completely indigenized this product category. Major orders bagged in Q4 FY21 were from Birla Cement in Nagpur, Avenue Supermarket at Vijayawada and Surat, ISRO Bangalore, Flextronics Chennai, Gujarat Biotechnology Ahmedabad, and West Coast Pharmaceuticals Ahmedabad. Our international business. Normalization of business activities enabled a growth in revenue during the quarter. We witnessed improved demand for both air conditioning and refrigeration products across SAARC and ASEAN markets, with channels stocking up for the upcoming summer sales. The upcoming Expo 2020 at Dubai and the FIFA tournament at Qatar are expected to offer growth opportunities. The macroeconomic environment in the region is expected to improve, driven by the establishment of trade relations between Israel and UAE and the thawing of ties between Qatar and the GCC countries. The projects business at Qatar and Malaysia continues to be impacted owing to COVID. While the subsidiary at Qatar received some notable orders towards the end of the year, that will get billed during FY22. Order inflow and the pace of execution with joint venture at Malaysia continues to be slow due to macroeconomic instability. We continue to focus on the expansion of the Blue Star product range and building brand awareness and brand visibility in different markets that we are present in. I will now talk about Segment 2, Unitary Products. Segment 2 revenue, which recovered 84.5% in Q2 FY21 and 117.3% in Q3 FY21, continued to improve its recovery trajectory and grew 31.1% to rupees 781.81 crore in Q4 FY21 as compared to rupees 596.28 crore in Q4 FY20. Segment result was rupees 62.06 crore, 7.9% of revenue in Q4 FY21 as compared to rupees 43.75 crore, which was 7.3% of revenue in Q4 FY20. Revenue for the year recovered 81.2% to rupees 1868.28 crore in FY21 as against rupees 2300.61 crore in FY20. Segment result was rupees 108.82 crore or 5.8% of revenue in FY21 as compared to rupees 162.27 crore, which was 7.1% of revenue in FY20. Due to unprecedented increase in the raw material costs, including steel, copper, and ABS plastics, as well as ocean freight, the prices were increased between 5 and 8% for various SKUs with effect from January 1, 2021. Cooling and purification products business. Stocking of inventory by channel ahead of the peak selling season, improved share of billing from the e-commerce channels, and a general business sentiment improvement enabled a growth in revenue for the room air conditioner business in Q4 FY21 as compared to Q4 FY20. The room air conditioner market grew by 27%. We grew by 33% and expect to have improved our market share to 13.25% in Q4 FY21. Other products such as water purifiers, air purifiers, and air coolers are performing well in line with our plans, and we continue to gain market share. We achieved a market share of 3% in water purifiers with a major share of billing to e-commerce players. Having reached a break-even level, water purifiers will be an e-commerce centric product portfolio going forward. Commercial refrigeration business. Our commercial refrigeration business witnessed good traction across all product categories during the quarter. Improvement in demand across all customer segments, coupled with aggressive stocking by the channel, enabled a growth in revenue during Q4 FY21 as compared to Q4 FY20. In addition to continued demand from the healthcare, pharma, and food processing and food delivery segments, order inflows also improved from restaurants and the government sector. With the launch of a new range of pharma cold rooms, medical freezers, ice-lined refrigerators, and vaccine transporters, we offer an end-to-end solution for vaccine distribution. Our products have been well accepted by the government, vaccine manufacturers, and private distributors. We continue to be the market leader in the healthcare and pharmaceutical sector. We continue to also witness healthy growth for our supermarket refrigeration equipment, driven by the growth in the retail sector. With the launch of our super coolers, we now also have a complete range of visi-coolers, enabling us to gain momentum in this segment as well. Major orders were bagged in Q4FY21 from Dr. Reddy Labs, Apollo Hospitals, Aurobindo Pharma, Zydus Cadila, Rebel Foods, Swiggy, Reliance Retail, etc., to name a few. Segment 3, Professional Electronics and Industrial Systems. Segment 3 revenue grew by 16.6% to rupees 49.79 crore in Q4 FY21 as compared to rupees 42.69 crore in Q4 FY20. Segment result was rupees 7.22 crore, 14.5% of revenue in Q4 FY21 as compared to rupees 7.50 crore, 17.6% of revenue in Q4 FY20. Segment revenue for the year recovered by 75.8% to rupees 176.59 crore as against rupees 232.91 crore in FY20. Segment result was rupees 33.81 crore, 19.1% of revenue as compared to in FY21 as compared to rupees 54.34 crore, 23.3% of revenue in FY20. Revenue and profitability were higher in FY20 on account of few large value orders in the data security solutions business. Revenue of this segment continues to be driven by opportunities from the BFSI sector for the data security solutions business, order inflows from the healthcare sector, and orders from the essential services of the government sector. Major orders were bagged in Q4 FY21 from FIS Payment Solutions and Services, Navodaya Education Trust, Geo Platforms, IndusInd Bank, ICICI Bank, etc., to name a few. With a wide portfolio of products and solutions forming part of our offerings, the prospects for this business segment are positive. Business outlook. Robust business recovery witnessed in the second half of the financial year enabled us to end the year with a strong quarter. In the electromechanical projects business, we continue to prioritize our project execution based on assessment of customer credit profile and operating cash flow visibility. The government's focus on localization under the Atmanirbhar Bharat program has brought in good opportunities for the company in the manufacturing sector. We have strengthened our product portfolio under all categories in room air conditioners and commercial refrigeration. Digitization and healthcare initiatives continue to offer good prospects for the professional electronics and industrial systems segment. However, the sustenance of this growth momentum has been challenged by the second wave of the pandemic. Restrictions similar to lockdowns of varying degrees in many parts of the country since the middle of April 2021 might impact the planned revenue growth for April and May. We are focused on maximizing the revenue in the markets which are open and at the same time moderating the inventory levels and operating costs. As on date, our factories at Himachal Pradesh, Dadra and Ahmedabad are operational, and the Wada plant is operational for executing export orders and domestic pharma and healthcare contracts. With the experience gained in the previous year, our focus continues to be on keeping our employees, dealers and business associates safe, fulfilling emergency needs of our customers, building resiliency and operating agility. As in the past, we are confident of sustaining this phase in a prudent and balanced manner and continue our growth and expansion trajectory. With that, ladies and gentlemen, I am done with the opening remarks. I would like to now pass the call back to the moderator, who will open the floor to your questions. I will try and answer as many questions as I can. To the extent I am unable to, we will get back to you via email. With that, we are now open for your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Lavina from Jefferies. Please go ahead.
Yeah, hi sir. Congrats on a good set of results. Just 2 questions. Firstly, on the air conditioner market, how are you viewing the impact of these localized state-wise lockdowns? Do you think it will be very material, or how are you viewing the channel inventory levels in that context? Secondly, sir, you said, this quarter has been hit by competitive pressures. Do you see this easing off, or do you see this continuing in the course of the year? Thanks.
Sure. All right. So the 2 questions you've asked, Lavina. Now, of course, till about second week of April, around 10th April, you can say, the market as well as the overall business prospects were quite normal, as we can expect them to be normal during the summer season. So it is only probably towards the middle of April, things started to a little bit get shaken up because of the lockdown-like restrictions which many states and many cities have imposed thereafter for a varying period of time. So at this point in time, we are just taking one step at a time. So the overall impact in the month of April appears to be around 20%. If we compare our overall performance, what happened in the April of financial year 19-20, and even as compared to our plans, which will be impacted by around 20%. The month of May, of course, is still just starting, and depending on how different states choose to relax some of these restrictions, we will get to know. But needless to say, of course, there is going to be an impact in Q1, which of course was not anticipated again, and to that extent we have to continue to modify as well as change our tactical initiatives, pretty much like what we did last year, and respond to the changing circumstances. You asked a question around inventory. At this point in time, the inventory levels are pretty normal, because keep in mind we had a very, very good March. The month of March was quite good, and half of April, the first 10 days of April were also good. So we don't expect the inventory levels by the time we end the quarter to be significantly higher than the normal levels. It again depends on how quickly things start to normalize to a reasonable level. But again, we have to wait and watch, and like we did last year, we have put into place the course-correction measures to ensure that we are rebalancing our production requirements in line with the growth trajectory that is now becoming visible. As far as competitive position is concerned, of course, the intensity of competitiveness does not reduce. That is also compounded by, or has been compounded by, the increase in input costs, raw material costs. I talked about increase in ocean freight costs as well. Now, those are competitive pressures we have to again continue to respond to. And like I said, we took some price increases, and to some extent, whatever the market has been ready to absorb, we have taken those course correction measures, and we will again continue to respond as the situation unfolds on the competitive intensity as well.
Thank you.
Thank you. The next question is from the line of Ravi Sominathan from Spark Capital. Please go ahead.
Hi, sir. Thanks for taking my question. My first question is, I had missed the number of the order inflow for the E&P segment for the full year. If you can give the numbers, sir.
Yeah, just one second, Ravi. So I'll give you the order book position
Okay.
for the EMPG. So overall carried forward order book is close to carried forward order book is 2149 crores as of March 31, 2021. Order inflow during the year was 2,244 crore rupees as compared to 3,100. Last year, of course, we got some large orders from Metro Rail. That's the reason why last year was a bit higher. But it has been pretty encouraging even in FY21 as far as order inflows are concerned.
Got it, sir. Got it. And for at a company level for the quarter, the gross margins have taken a sharp correction. But we have taken 5 to 7% price increase at the UCP level. So do we see gross margins correcting back to older levels in the subsequent quarters because of this price increase, or do we need more price increases to compensate for the fall in gross margin?
So I talked about, there are the trigger for gross margin pressure in Q4 is principally, primarily the unprecedented increase in input cost increases that had actually started somewhere in November, December, and then they intensified in Q4. So we did some course correction. So like I mentioned, we took a price increase ranging from 5 to 8% in Q4. So that has been partially already, incorporated in the overall revenue that we got. We have taken a further price correction in April, which ranges from 3 to 5%, which is now getting rolled out depending on how the market opens up. So the overall impact will be there for some more time. And of course, we are hoping that some of the commodity prices should start cooling off as the market normalizes. So it's just simply wait and watch. And we have done whatever course correction within the acceptable limits we could implement on the pricing front.
Got it. And my next question is with respect to other costs. It has fallen by 20% year on year. I mean, throughout the year, it has seen a decline compared to the top line. How much of it is contribution to the ad spends being cut, sales and promotions being cut, and any other costs which are getting cut? So, how much is, to be precise, how much is ad spends and sales and promotion as a percentage of sales this year vis-a-vis last year, and how is it likely to pan out?
So I'll keep it at an overall level, Ravi. The other cost includes the entire SG&A, and that as far as you've seen overall around 36% reduction. Now, of course, marketing is just one element of it. So you remember we've been talking about some pretty incisive cost rationalization measures that we started implementing in April last year itself across all our cost lines, right from, of course, line items such as travel, which naturally reduced. But even rentals, we went back and renegotiated with all our warehouse owners and our office premises. Then, of course, the selling expenses to the extent they had to be rationalized. So this entire rationalization is across the board. Now, how much of it will sustain in FY22? We are still working out, that visibility. Some of it will, because the external environment is still not conducive to normal business activities. For example, activities such as a product launch, which is now happening in a virtual environment, is likely to continue for some more time. So some part of our operating cost reduction that we achieved last year will or should continue, but part of it will come back as business starts to normalize. So it is across a number of lines.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, leaders. The question is, if you look at in the UCP segment, the other business apart from the AC, how that has responded in the last 1.5, 2 months time of, rather put a 1 month time of this lockdown, if you can throw some light. And going forward, we were trying to localize few products in this particular category. So when is the timeline? I think there's one plant which about to get commissioned in terms of local indigenization and all. So if you can throw some light on that, and as well as on the MEP, Has there been a less impact because construction is allowed in Q1 versus the other segments where you're saying the impact is more? Those are the two questions.
All right. Thanks, Nitin. Yeah, so I did talk about, the room AC, products that are comprised in the unitary product segment, which is largely a commercial refrigeration range of products. Now, as far as the commercial refrigeration business is concerned, we have actually, again, we continue to see some very encouraging response across the customer categories that we serve, right from healthcare, pharma, food processing, food delivery segments. I'm sorry, though the usual customer segments which this particular product category serves, which is the ice cream manufacturers, for example, continues to be under a bit of a challenge. So even restaurants. So this we also sell quite a few of products to restaurants and some government sector as well. But there has been a good uptake from the pharma, healthcare, and the supermarkets, and we have now a complete range of refrigeration products which serve the needs of all of these customers across these segments. Then I also talked about the entire cold rooms, the pharma cold rooms, and the medical freezers, which are very specialized equipment which are now in great demand because of the ongoing situation. Also, we also launched last year a complete range of new ice line refrigerators which are now needed for transporting vaccines and also vaccine transporters. So while it may be a slightly short duration opportunity, like we said last year, and overall maybe over the next few quarters that might get fulfilled, but at this point in time, pharma, healthcare sectors do seem to be encouraging. And of course, as the second wave starts to ebb off and the overall situation starts to normalize, we expect the traditional customers in our commercial refrigeration segment should also start to regain their growth trajectory, and that will reflect on our numbers as well. So this is as far as the commercial refrigeration is concerned. Of course, we also have water coolers and water purifiers in the UCP segment, which are, and like I mentioned, water purifiers quite consciously and strategically we have made these e-commerce distribution play, and it's working well because again in the current environment, e-commerce, any products which are more suitable for an e-commerce distribution have a good prospect as far as the market potential is concerned. So that's on water purifiers. Water coolers also have been slower than expected in terms of their offtake because our key customers there are government institutions, educational institutions, and to some extent, of course, those segments are yet to recover fully. So other than the room ACs, we have a range of non-room AC products which are included in this particular segment, which are showing some promising results. Now you talked about MEP. As far as the MEP projects are concerned, there are two sides to our MEP projects. One part we've been talking about relatively consistently, which is our decisions to take on a new order and continue to fulfill the servicing obligations is being closely linked with the overall credit profile and operating cash flow visibility from ongoing projects. So that continues. That is not changing regardless of how the external environment is playing out across different regions of the country. The other part is to the extent, we have seen some very encouraging response from light industrial data centers as well as, the warehouses, e-commerce warehouses. So there's some good work opportunities and of course infra sector as far as the government infra projects are concerned. So that the impact so far of construction is not as profound as it was last year. Because last year, if you remember, there was also an added issue around migration of the labor force, which did impact to some extent across some sites. And then the sites were, in fact, when the national lockdown happened last year, all the job sites were put under suspension at that point in time, which is not the case this year. So it's a bit localized, it's a bit regional. The extent of disruption is lesser so far. And like I said, since it is likely to be more state specific and presuming, hypothetically, let's say if Maharashtra and a couple of other states which are looking a little bit more stable, assuming if they start to open up relatively faster over the next few weeks, then the normalization of our business activities in those states also will follow. So that's how we are doing a very close watch and monitoring of all the MAP job sites which are currently going on.
And Neeraj, just one more question on this commodity. I understand you said we took a price hike, we're trying to negate the cost impact. But when we look at only the commodity basket for April, it's up. This is our calculation. You can correct me. It's almost up closer to 250-300 basis points. So this is something and I'm understanding optically the inventory would be higher because the stores would not be selling much. I'm not talking about the March end inventory. So once you start selling, even if the country starts opening up or the incremental starts opening up, do you think the passing full price would be that easy this time, considering being a seasonal product and generally the sentiment is a little weak, what has happened in this wave versus the last one? Just need your input in that. That's my
So correct. That's a good point. So keep in mind two things. Firstly, the inventory build-up for Q1, which is the selling season, typically starts to happen in Q4 or around Q4, and for which procurement happens a couple of months ahead of that. So to some extent, whatever price increases in commodity ocean freight had to happen, which has impacted the inventory, raw material inventory, which we hold, has already been taken in the inventory cost. Now, of course, we are going to moderate a little bit the production pace for the next 2 or 3 months because we have sufficient stocks to sell in the background of the current disruption. On top of that, if you remember, I talked about a 3 to 5% price increase that we have taken additionally from 1st of April. So we are hopeful that the 3 to 5% price increase on top of a 5 to 8% increase that was taken in Q4, and the fact that in the next 3 months or so, the pace of procurement will also slow down, and if let's say in the next 3 months the commodity prices start to cool off, then the overall pricing pressure probably will be relatively lower. But in the interim, of course, this is a challenge, and this is going to be faced by all the players, where the cost of inputs definitely is one major issue to be addressed in order to preserve margins to whatever extent. But like I said, since it impacts the entire industry, there should be some calibrated actions, in at least directionally calibrated actions. The quantum may differ across players over the next few months, which will probably help solve the situation.
Thank you. We would request the current participant to please come back in the question for any follow-up questions. The next question is from the line of Bhumika from DAM Capital. Please go ahead.
Yeah, good morning, sir, and congratulations on a good set of numbers. So my first question is on the margins of the UCPL segment. If one looks at it, we had a fairly strong quarter in terms of strong revenues, wherein we saw higher volumes, there were price hikes, and we also had the benefit of some expenses being much lower due to the cost rationalization. So in that sense, the margins to some extent seem a bit lower. And was there a mix issue or something else that prohibited the kind of an improvement in the margin profile? That's my first question.
Sorry, there seems to be some interruption in the Bhumika.
Yes, sir. You can hear me?
There was a little bit of, unless the network at my end was an issue. Can you just,
sure, sir.
in brief, if you can please repeat your question, please?
Yes, sir. Sir, I was asking about the margins for the UCPL segment, where there was, we saw a fairly strong quarter in terms of revenues with higher volumes, price hikes, etc. And on the other side, we saw, costs of other expenses and employees, etc., being much lower. But despite that, margins have not really seen an improvement. Where do we see the trajectory of margins in the next couple of quarters or, in the foreseeable future when things normalize? When do we see them hitting an 9 to 10% kind of a level?
So Bhumika, I mean, if you look at two successive quarters, now we are almost having around 8% margin in this particular segment. So I think Q4 is 7.9%. Q3 was also in the same range, a similar range. So we are holding a margin profile of around 8%, which is pretty much what we were hoping for, which is after counterbalancing the impact of. So while you're right that the operating cost elements are lower, but at the same time, the overall increase in the raw material cost has been also of a huge order. So this margin profile of 8% that you see is after absorbing all that price, the cost, raw material input cost increase and ocean freight increases. So we are not planning at this point in time too much down the, for the future, many quarters at this point in time, but clearly we would want to maintain this kind of a margin profile and hold on to it. And that's the reason when I talked about the price increases that we have taken in Q4 and again in Q1, with an intent to neutralize the downward impact of some of the input cost increases. So this is a reality because obviously the scale of disruption in the input costs is also quite high.
Got it. So what would have been the impact of water purifier? And if you can talk about our CapEx plans and with the PLI scheme, are we looking at investing in some component manufacturing, any new plant, etc.? If you can talk about that. That would be my second question.
Yeah. So water purifier I covered during my opening remarks. We have hit around 3% market share. The segment has hit a break-even level. And based on learning of the last 3 years, we realize and we feel that this particular product category will be best distributed predominantly through e-commerce till such time we hit a critical scale, the next critical scale of say 5 or 6% market share, which is where we will start penetrating deeper into the stores, the retail stores format. And when at least in the next few years or the few years, because the e-commerce recovery, a very natural selection of distribution for products which are kind of plug and play. So it fits in well with that strategy. We have achieved a break-even in FY21. We reported that I think the last quarter as well. And so now going forward, water purifiers will not be that good as far as margin side. It's going to something starts to go beyond the break-even level. Of course, it will start contributing and with the overall margin contribution. The PLI, I want to talk about it a little. So we have been watching the PLI announcements quite closely. As the notification which came out somewhere in the month of April reads, the PLI incentive is meant for the components. Unlike the initial impression that we had that it will also cover or might cover the finished products. It is not intended to cover finished products, it covers components. So it still is with the indirect benefits because over the period of time, of course, it's going to take a couple of years, when more and more components like electronics and some other components which like compressors probably, which will start getting manufactured in India, indirectly that benefit of PLI will start getting passed through to the end manufacturers as well. So as far as our own plans are concerned of expanding our manufacturing footprint in Sri City of Andhra Pradesh, which we talked about, at this point in time, it is going to be now more driven and closely linked with the need for us to expand our capacities in line with our plans than the PLI imperatives, which would have been there for us to invest CapEx probably slightly more accelerated. If PLI was to become applicable for us. So to that extent, our expansion plans continue. We have commenced work on preparing our plans for setting up this new manufacturing facility in Sri City, which we will talk about as those plans get finalized. And over the next couple of years, that facility should start operating as well. And like I said, it is not going to be calibrated with our own internal plans than any external need. And as that happens, we will continue to focus more on indigenization, backward integration, like ideas which we have entirely done. So there are a few more components which are planned when we look at the Sri City factory, which will also be covered in that particular plant. So that strategy of increasing backward integration and indigenization continues to be on a high priority for us.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions. The next question is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
Yeah, hi Neeraj. A couple of questions. Firstly, just harping on the product margin, was there any impact of your entry into or maybe expanding into the more affordable product range in the quarter, and will that be a consideration going forward also on the margins? And yeah, so this is the first question.
Yeah, so Anupam, we already talked about, because we are calling it mass premium, it's not as much about being affordable. So mass premium because obviously the premium less about our products in the context of the quality, performance, and the reliability that our customers are, that the brand is associated with. So we maintain that. Yet in terms of the mass appeal, in terms of the price points at which those products can be offered, it's a complete leverage that we launched in Q4. And we got some good traction, and part of the growth that you see in Q4 is also because of that strategy playing out quite well. So that continues, and that focus will continue because that's where we believe the next wave of growth for us sits, which is the mass premium segment. And so clearly, had it not been for, of course, this sudden raw material input cost increases, the overall margin profile of these products compares very well with our expected and our, historically what we have been experiencing our margin profile. So that we don't foresee to undergo any change. Of course, the variable that needs to get under some range of normalcy is the raw material and input cost, alternatively settling down of price increases that we have taken. So I guess we'll watch closely over the next few quarters to continue to recalibrate that entire customer segment.
Okay. Understand. And the second question is related to projects. I think, as I understand, most of the projects business is fixed price in nature. And despite that, 4Q margins were pretty healthy. Do you see pressures in the project margins in the first quarter and the second quarter in this year because of the high raw material, or will you delay the execution? How will that pan out?
So you're right. The MEP projects are mostly fixed price contracts by the very structure. However, it's a little easier as far as the project business is concerned because when we bid for projects, when we do our costing, when we do our tendering, at that stage itself, we try and get some back-to-back supplier commitments for a period of time. Now, of course, if the project is going to get delayed beyond the committed time period, then that creates a price increase issue for us. But there is an element of price protection, procurement price protection for a period of time that is visible to us when we bid for the project. Some contracts may have a price variation clause as well, where indexed with the whole price index or some other indexes. So to that extent, there is an element of mitigation against a spike in raw material prices, which is there in the project cost. So we really don't need to moderate the pace of our execution or anything like that.
Okay. Understand. That's all. Thank you.
Thank you. The next question is from the line of Bhavan Vitlani from SBI Mutual Fund. Please go ahead.
Okay, thank you for the opportunity and congratulations for good set of numbers, and especially enthused by the speed at which the company responded in terms of new products respect to the current situation. Neeraj, I have a couple of questions. One is on the commercial refs, historically it used to be 30% of the segment. If you could speak about it, what was the growth in the full year? And what are the new products that we have introduced last year, and how has our market share changed? If you could speak about the commercial refs, that is very useful.
Yeah, so I'll cover it in two parts, Bhavin. Firstly, what we've been sharing with all of you is in the UCP segment. The overall proportion of UCP versus non. So there's been a basket of non.
Sorry to interrupt, your audio is breaking. We're not able to hear you clearly.
Is it better?
Yes, sir, you can go ahead.
Is it better? Okay. All right. So I'll just repeat the answer that I was giving. So in the United segment, predominantly, historically, we had room ACs contributing to the highest share, which used to be the case until about 3 or 4 years ago. Now, as we speak, the share of non-room AC set of products, it includes commercial refrigeration products, is now roughly about 40%. It used to be about 30-35% kind of a couple of years ago. So it's already that mix is shifting in a very healthy way in terms of the overall room AC and non-room AC products. As far as the commercial products are concerned, we have a complete new range of cold rooms, which are actually catering to the new requirements of the pharma sector, medical sector, which are very which are again
the audio was breaking again, so we are not able to hear you.
Just give me, I just switch off my headset and just give me half a second. Is this any?
I don't know, it's still the same.
Is it still the same?
Yes, sir.
Okay. Why don't you call me on the other number, Aisha?
We can hear you now, really. Now it is clear.
Now is it okay? Actually, this Vodafone signal seems to be an issue. Is it any better now, or do you want me to?
You can go ahead.
We can go ahead? All right. So I don't know to what extent I was clear. So what I was saying that just I'll repeat very quickly. Firstly, we are strategically shifting the proportion or the composition of non-room AC product revenue in the unitary product segment. So at this point in time, it stands 60% being rest of the products and 60% being room ACs. Within the 40%, of course, the largest share is of commercial refrigeration products. And the new range of products there includes pharma cold rooms, medical freezers, and an entire range of vaccine supply equipment, which are offering end-to-end solutions. So we are expanding, and also the supermarket, a range of supermarket refrigeration equipment. And with the advent of several of these large format supermarket players, we are seeing some good traction in supermarket refrigeration equipment, including Visi coolers, etc. So we are quite bullish for the experience we've had in the last few years, and we this strategic diversification of unitary products segment will continue to help us in a very healthy way while we continue to achieve our desired growth rates on the room AC category. In the non-room AC category, we will also continue to see some good traction. So, Bhavin, I thought that was your question. I hope I have addressed it.
Sure. Yeah. Thanks, Neeraj. Just if I could ask a similar question for commercial refs as well, because this is a segment we have been focusing. What percentage it will be of? It used to be 30% historically, and how are we seeing growth prospects in this?
That's what I said, Bhavin. So we are not giving a line itemized breakup of these all the products which are there in segment 2. We're just giving headline level room AC and all other products, and all other products includes a number of other products as well, including water purifiers, water coolers, water dispensers, air purifiers, air coolers. So there are a number of non-room AC products. It's a complete basket. In that basket, of course, commercial refs are probably the highest contributing range. But that's how we are, looking at this particular segment.
Thank you. The next question is from the line of Amber Singhania from Asian Market Securities. Please go ahead.
Thank you, Neeraj, for taking my question. Sorry to harp upon on the same point of margin. Just wanted to get a color, like even if I compare Q4 FY19 versus Q4 FY21, there has been a sharp decline on the segment margin of unitary cooling products from 10.4 to 7.9. Despite in FY19 we had advertising cost, we had losses coming in from the water purifier segment. I understand the commodity prices have moved up significantly. So two things is, one, is there anything more we are doing to maintain this margin? Because going forward, when the advertising cost will come back and the commodities are continues to be remain firm, do we still maintain that we will be able to maintain this margin, or there is further downside on this margin on the UCP product from here onwards? What makes us confident that we'll be able to maintain this margin on that part?
On the one clarification, the advertising and marketing cost has been brought back in Q4 to the normalized levels, because the overall business was. So I would say that it is in FY19 Q4 or FY19-20 Q4. You're looking at FY18-19. So FY18-19 Q4, whatever would have been the relative spend on brand building as well as advertising and marketing, in proportionate terms, we are back on track as far as that is concerned, because Q4 pretty much for us was a good growth quarter. So there is no reduction as far as that cost is concerned. So as you rightly said, the entire pressure on the margin is because of some very rapid increases in the overall input costs, which have hit us in the financial.
Hello.
Neeraj sir, we are not able to hear you. We would request the participants to please stay connected, as the line for Mr. Neeraj Basoor got disconnected. Thank you for patiently waiting. We have Mr. Basoor connected. So you can go ahead, please.
Sure. Yeah. Am I audible now? Is it clearer? Better?
Yes, it is much better.
Okay. My apologies for this disruption, because the telephone connection seems to be an issue. All right. So I'll just very quickly repeat what I had just said. So first point I made was that our advertising and marketing and brand spends in proportionate terms are back to our FY18-19 levels as far as Q4 is concerned, and there's no letdown there. The second point is the increase in input and raw material cost in FY21 has been pretty steep. We did not face that kind of a raw material pricing pressure in cost pressures in FY18 or FY19. The third point is we started the FY21 with an inventory problem. And you'll remember that we were supposed to have taken a price increase because of it. Just keep in mind, there were two sets of customs duty increases in the year before, in FY20. Once in September, another one in February, which we had said we will start passing on to the customers beginning April 20, which we could never do. And so there was an element of price increase which could not happen because of the disruption. There was inventory pressure which was putting pricing pressures for at least 2.5, 3 quarters. So there are many factors which are causing, so the positive way of looking at it, that despite having severe headwinds through the year, from where we started the year and where we ended the year, and of course the measures which have been taken further in Q1 this year, we think the margins will normalize. And as the market stabilizes, this is not a normal year end of the day, and we have to just wait for a little bit more stability in the environment to settle down. So that's one context of looking at the overall margin performance. I know there are too many questions on margin, but this is just a snapshot where we think that coming back to 8% is a recovery which has happened because of several actions which were also undertaken during the year.
I understand. That's very helpful, Nilesh. Secondly, just wanted to understand on the import ban which government has imposed 2 quarters back. How do we see the scenario now panning out for us as well as for the industry? Have most of the imports have already shifted to India, or is still companies are continuing importing and getting it gas refilled in India as such? Both if you can give some context from our perspective as well as from the industry perspective. And just along with that, for the component on the PLI side, are we keen on applying for the license for the PCB boards and all?
So I'll very quickly cover both because now we run out of time. So as far as the question is concerned on the PLI, I already addressed, because since the finished goods are not covered, so we don't think we will apply for the PLI license, but we will get indirectly benefited once the components, whoever undertakes PLI manufacturing of components, we will anyway procure locally and source locally. That benefit will flow. The first question you asked on import, I'll address for ourselves. So our own import of finished products is almost zero over the last few quarters. So whatever is being sourced is being either manufactured by us in our own factory, or we also own certain components or certain SKUs from Indian contract manufacturers. So that is completely taken care of.
Thank you. That will be the last question. I would now like to hand the conference over to Mr. Neeraj Kasoor for closing comments.
Sure, thank you. Thanks very much, ladies and gentlemen. With this, we conclude this quarter's earnings call. I can see there are quite a few questions which we could not take up because of the lack of time. So, but feel free to revert to us in case any of your questions were not answered, and we will provide you additional details by email or in person. In any case, we are also planning to have next week analyst calls that we are going to host, and you will hear from Ad Factor soon on that. So probably you may seek further clarifications during those interactions with our two MDs. So I invite you to join that. And I would like to close the call by wishing the best of health to all of you, and do stay safe and stay protected. All the best, and thank you very much. Bye.
Thank you. On behalf of Blue Star Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.